Welcome to Voice Daily Finance, the most important news personalized for you every day. Supported by Voice.com.
In today's episode, you'll learn about, first, today's US market review. A tech bloodbath rocks Wall Street as giants like Amazon and Nvidia plummet. But beneath the chaos, smart money is quietly fleeing to a forgotten sector. Is this a crash or a historic rotation? Second, AI kingmaker crowned. Anthropic's valuation skyrockets to $350 billion as Microsoft and Nvidia wage a high-stakes war against OpenAI. Microsoft is now betting against itself by backing OpenAI's biggest rival. Is this a brilliant hedge to control the entire AI ecosystem, or a gamble that could backfire spectacularly? Finally, crisis alert. Home Depot's profit warning reveals a consumer deferral mindset that's crippling the US economy. The lock-in effect has frozen the housing market, but the real danger is spreading. If this consumer pullback hits the services sector, what's stopping a full-blown recession? Red alert, the market's sounding the alarm, and if you're not paying attention, you're going to get burned. Yesterday, the S&P 500 dropped 0.92% to close at 6,672.41, and the Nasdaq sank 1.2% to 22,708.07. I'm telling you, this isn't just another market dip. It's a signal that you need to act fast. Tech stocks are in freefall, and if you're holding on, you're risking it all. Why the panic? The tech sector is taking a beating as investors rethink the sustainability of astronomical AI capital expenditures. When giants like Amazon and Meta announce massive spending without clear returns, the market gets jittery. And with consumer sentiment dropping 6% in November, concerns about economic weakness are real. The ADP report shows job losses, and Home Depot's weak sales are a red flag that consumer spending is slowing. The Fed's rate cut prospects are now a coin flip, adding another layer of uncertainty. Let's break it down. First, the Fed's policy path is unclear. Rate cut probabilities for December are at 50%, down from earlier expectations. This uncertainty is a knife to growth stock valuations. And with inflation expectations still high, the Fed isn't rushing to ease rates. Second, money flows are shifting. The VIX is up, signaling growing fear. Investors are pulling out of tech and seeking safety in small caps and defensives, a clear rotation away from high beta growth plays. Third, valuations are under the microscope. Tech's high P divided by E ratios are getting a reality check. The Nasdaq's decline shows the market's repricing risk, especially for mega cap tech with stretched valuations. Listen to me, cut your tech exposure immediately. Rotate into defensive sectors like healthcare, XLV, and consumer staples, XLP. This isn't a market-wide crash, but a targeted repricing. Protect your portfolio by rebalancing now. Don't wait for the dust to settle, because by then it'll be too late. Looking at sectors, tech is bleeding. Amazon plunged 4.43%, Nvidia dropped 2.81%, and Meta's stock is in bear market territory. This isn't a random sell-off, it's a systematic repricing of overvalued segments. Conversely, energy and healthcare showed resilience, with Exxon up 1% and XLV climbing. Small caps are unexpectedly strong, signaling a potential shift to value and defensive plays. Here's your strategy for today. Good advice makes you rich. Bad advice costs you a fortune. Listen to me. Short term, reduce your tech weight by 15 to 25%. Focus on cutting Amazon, Nvidia, and Meta. If Nvidia disappoints in tomorrow's earnings, expect further declines. Target defensive ETFs like XLP and XLV for stability. Medium term, shift 3 to 5% of your portfolio into consumer staples. If consumer sentiment falls further, staples will outperform. Watch for unemployment data. If it worsens, increase defensives. Lastly, hedge your risks. Advanced investors consider buying QQQ puts for downside protection. Intermediate, use inverse funds like SQQQ. Basic, raise cash to 10 to 15% of your portfolio for flexibility in uncertain times. Time's running out, and these moves are your lifeline. As we await Nvidia's earnings, remember, hold strong, but stay nimble. Now, let's take a closer look at the specific stories driving today's action. The story begins with a decision that caught everyone by surprise. The AI startup Anthropic just saw its valuation explode to an estimated $350 billion. That's up from $183 billion just 2 months ago. A while back, we walked through Anthropic's plan to scale Claude with up to 1 million chips and a heavy bet on Google's TPUs, a textbook multi-chip hedge. Today's spike is the sequel, the money and compute to make that scaling real, but with a different cast of partners. Now, a valuation this massive for a company with relatively little revenue is of course a huge bet on the future. And here's where it gets interesting. The bet is tied to what economists call the productivity paradox. For years, we've had amazing new technologies, but official economic statistics haven't shown a big corresponding boom in productivity. The wager behind this $350 billion number is that AI, specifically models like Anthropic's, will finally solve that paradox and unleash a new wave of economic growth. There are signs this might be starting. For example, US non-farm productivity just jumped 3.3% in the last quarter, the strongest growth in almost 2 years. But it's still early and the data is volatile. This valuation is a massive wager that this productivity boom is real and sustainable. The fuel for this fire? A massive strategic partnership with two of tech's biggest titans, Microsoft and Nvidia. Microsoft is pouring in up to $5 billion, while Nvidia is committing a staggering $10 billion. We previously analysed how Anthropic sought a second architecture in Google TPUs. The latest development is that they're now locking in supply and engineering support from the other two power centers in AI hardware and cloud. You know, these huge sums of money represent a new economic force. It's what some are calling an AI capital expenditure supercycle, where capital expenditure on AI infrastructure is so enormous it's creating new pressures on the economy. All this spending on chips, data centers, and the energy to run them strains supply chains. As we discussed a while back, some analysts were already warning that data centers could push past 11% of US power consumption by 2030. The latest projection we're citing today from the Electric Power Research Institute pegs it closer to 9%. Different models, same direction of travel. This surge in demand for power and components could create a new source of inflation, making it harder for the Federal Reserve to get inflation under control. This is where the situation takes a more complex turn. Microsoft is already the primary backer of OpenAI, Anthropic's biggest rival. This move is the clearest sign yet that Microsoft is working to reduce its dependence on OpenAI, effectively betting on both sides of the AI arms race. It's a direct challenge to the status quo, creating a complex web of alliances and rivalries at the very top of the tech world. And remember, we recently highlighted how OpenAI moved to adopt AMD's Instinct GPUs, and Oracle rolled out 50,000 Instinct chips early cracks in Nvidia's near monopoly. The common thread is what we called corporate compute sovereignty, top labs de-risking single supplier exposure by spreading bets across chips, clouds, and even architectures. So the thing is, this isn't just about betting on two different AI models. This is about the bigger war for cloud computing. Microsoft's Azure is in a fierce battle with Amazon Web Services, or AWS. By investing heavily in Anthropic and securing their business, Microsoft is trying to pull a major AI customer onto its Azure cloud platform. A while back, Anthropic leaned hard into Google's TPU stack. Today's Azure commitments show how that multi-cloud, multi-architecture strategy translates into bargaining power. This suggests a new phase in the cloud wars where companies are willing to sacrifice short-term profitability to gain long-term market share. For perspective, while Microsoft's Azure revenue is surging, AWS has seen its profit margins squeezed. This aggressive strategy could put pressure on the earnings of all the big tech cloud providers. Nvidia CEO Jensen Huang called the deal a dream come true, signaling a deep partnership to accelerate Anthropic's AI model, Claude. When AMD's big win surfaced, we said the first real pressure on Nvidia's dominance had arrived. This is Nvidia counterpunching with not just hardware, but capital and tight engineering alignment. The result of all this is that it solidifies Nvidia's role beyond just a supplier. It's becoming a kingmaker in the AI world with its dominant position in high-end chips. Nvidia's direct investment and engineering support can essentially steer the direction of AI development by choosing which models get optimized access to its next-generation hardware. This concentration of power in a single hardware provider is significant. It creates a systemic risk for the entire AI ecosystem and is already starting to attract intense scrutiny from antitrust regulators around the world. Meanwhile, Microsoft CEO Satya Nadella stated the industry needs to move beyond any type of zero-sum narrative, a direct nod to the intense competition heating up. But that's not the whole picture. This isn't just cash. Anthropic has committed to purchasing an incredible $30 billion of Azure compute capacity from Microsoft. It's also buying up to 1 gigawatt of compute capacity using Nvidia's next-generation systems. Continuing our last discussion, the second source isn't just another GPU vendor anymore. It's an entire portfolio across architectures, from Google's TPUs to Nvidia's GPUs, with spend anchored across multiple clouds. Ultimately, this deal further consolidates cutting-edge AI, capital, talent, and computing power into a handful of US-based companies. As we've noted, that's the corporate mirror of national sovereignty, plays the private sector version of securing your own silicon, energy, and data center footprint. This creates a powerful, concentrated AI stack that presents a direct challenge to China's state-led AI ambitions. It also puts pressure on other regions like Europe, which is pursuing sovereign AI to avoid technological dependency on the US. In fact, the EU has already announced plans for AI gigafactories to try and catch up. This deal deepens the US-China tech rivalry and will likely trigger more policy responses from other nations. While Amazon Web Services remains Anthropic's primary cloud provider, the new alliances with Microsoft and Nvidia show that the battle for AI dominance is escalating, with a few key players locking down the compute power that will define the future. A while back, we pointed out how Google's TPU momentum was pulling workloads its way. Today's update shows Microsoft winning a giant spend commitment, evidence that leading labs will keep portfolios spread across clouds and chip families. The key things to watch now are: 1, official productivity numbers to see if these massive AI investments translate into real economic growth, and 2, any policy or regulatory responses from Europe or China to this growing concentration of AI power in the United States. We were just talking about a mind-boggling $350 billion bet on the future of AI. Now, let's pivot from that massive investment supercycle to the reality on the ground for the American consumer, where spending is hitting a wall. Home Depot just sent a major warning shot across the bow of the US economy, cutting its full-year profit forecast for the third consecutive quarter. The home improvement giant now expects its adjusted earnings per share to decline by about 5%. That's a sharp downward revision from its prior forecast of a 2% drop, and it marks another big miss on Wall Street's expectations. The source of the trouble, in a remarkably blunt admission from Chief Financial Officer Richard McPhail, is that the company anticipated that demand would accelerate as interest rates eased. But that never happened. Instead, he stated that ongoing consumer uncertainty and continued pressure in housing are disproportionately impacting home improvement demand. Now, that pressure in housing is a crucial piece of the puzzle. A while back, we walked through how that pressure in housing isn't just about rates, it's about compounding costs and constraints, especially for more vulnerable borrowers. And that context helps explain what's happening now. Believe it or not, the US housing market is currently gripped by something called the lock-in effect. Essentially, millions of homeowners who secured ultra-low mortgage rates of 3% or less a few years ago are now unwilling to sell their homes and buy a new one with a mortgage rate of 7% or higher. This has frozen the housing market. By comparison, before the pandemic, existing home sales were typically around 5 to 5.5 million per year. Now, that number has plunged to just over 4 million. And even if distress rises, we've noted before that lower price inventory tends to get absorbed quickly, so affordability doesn't improve and mobility stays constrained. Fewer people moving means far less spending on renovations, appliances, and furniture, which is the lifeblood of a company like Home Depot. The numbers tell the story. While the average customer ticket rose slightly, the total number of customer transactions actually fell 1.6% year over year. Homeowners facing high borrowing costs are in what the company calls a deferral mindset. Big ticket kitchen remodels and major additions are being put on hold indefinitely. This isn't just about one company. It's a signal about the health of the consumer. As we flagged a while back, other credit delinquencies are creeping higher and the job market is softening at the margins, exactly the backdrop that encourages more deferrals, not fewer. And this deferral mindset is the real canary in the coal mine. If the psychology of postponing major goods purchases spills over into other areas, it could undermine the key pillar of US economic resilience. For the past year, the services sector, things like travel, dining, and entertainment, has been holding up the economy. But if consumers are now hesitating on a new kitchen, will they also start putting off that vacation or cutting back on going to restaurants? Recent data from the Personal Consumption Expenditures Report, or PCE, already shows a slowdown, with spending on services growing by a mere 0.2%. This consumer pullback brings both short-term savings for households and comes with the inherent risk of tipping a slowing economy into a full-blown recession. The market reaction has been swift, with the stock tumbling on the news. This year, Home Depot shares are down about 8%, a stark contrast to the S&P 500, which has gained 13%. The company is trying to pivot by acquiring businesses that serve professional contractors, but what really brought this to a head was the realization that even this pivot to professional contractors isn't a guaranteed safe haven. After all, spending by these pro customers is itself a highly cyclical leading indicator for construction and employment. If the pros also start to see fewer projects, it signals a deeper slowdown is on the way. And if you're looking for a quick rebound, the company's own leadership is pouring cold water on that hope. The CFO's final word on the outlook was chillingly direct. At this point, it's hard to identify near-term catalysts that would lead to acceleration. So what's next? The key here is to watch whether this consumer deferral mindset spreads. The two most important indicators to monitor will be the monthly existing home sales data and the services spending component of the PCE inflation report. Continuing our earlier discussion, add the FHA delinquency rate and regional insurance premiums, especially in places like Florida and Texas, to that dashboard. If all of these continue to weaken or worsen, it would confirm that the slowdown is broadening. This could put more pressure on retail and service-related stocks. For our audience in China, a weaker US, consumer means lower demand for imported goods, which could impact China's export-oriented industries and potentially add pressure on the exchange rate.
That's it for today on Valuation Daily Finance. Follow, share, and stay tuned for daily updates coming your way tomorrow.